Everybody says it. Diversify, diversify, diversify. Sounds smart, right? But here's the truth. Nobody wants to say it out loud. But diversification, at least the way most people use it, actually sucks. Most people aren't diversifying to win. They're diversifying to protect themselves from their own laziness. They're not trying to grow wealth. They're trying to make sure they don't have to pay attention. Big difference. Yo mama's so poor, she can't even pay attention. Sorry, can't help myself. But most people diversify so they don't have to understand finance. And so they leave themselves in the dark on one of the most important decisions of their life. And don't just take my word for it. Warren Buffett said it best. Diversification is protection against ignorance. It makes a little sense if you know what you're doing. Alright, let's be real. If you know what you're doing, you don't need 1,000 eggs. You put a few eggs in a very few good baskets. And you watch those baskets like a hawk to and spit on that thing. I'm not a financial advisor. I'm just here sharing what I've learned from real experience. So always do your homework, my friend. So now don't get me wrong. There is a time and place for diversification. If you just started and if you don't have time to study companies, if you're focused on your main career and you want a safe way to grow money slowly, yes, diversification may make an itty-bitty sense, like maybe owning an S&P 500 ETF, but I still wouldn't do anything about investing if I don't know what I'm doing. What I would do though is I would split my money between stocks, a little bit of real estate, and maybe hedge with gold and silver. But that's called intentional diversification, not blind spray and pray, because you don't know what you're doing. The problem with most diversification is it's just a 401k or 403b autopilot. People throw their life savings into 10, 20, 30 different mutual funds that they barely understand. They cross their fingers and hope the market always goes up. And that's not a plan. That's outsourcing your future to luck, to leprechauns. By the way, quick story. One night I treated myself to Chinese takeout. I ordered orange chicken. And man, when it came, they gave me one single fortune cookie. Just one. So I complained, bro, where's the second cookie? And the guy said, one fortune cookie is enough for you, my friend. If you need more, you're confused, alright? I can do this because I'm Asian, sorry. But I just made it up too, but only because it's the same thing with investments. If you need 27 different funds to feel safe, you're probably just confused. You don't trust anything because you don't understand anything. So when is diversification powerful? Number one, asset class diversification. You got stocks, real estate, precious metals, maybe even some Bitcoin if you understand the risks. And then you got growth stage diversification, having some fast growing investments and having some boring, safe, cash flowing ones. And then you got global diversification. If your home country tanks, you're not wiped out if you diversify globally. Now, when is focus better? When you know the business like the back of your hand. When you can watch it, manage it, react, and make the best decisions yourself. And when you're young or trying to grow faster and also want to understand things in a deeper level. Focus. Alright, I got a simple rule for you. Diversification preserves. Focus grows. When you're trying to build wealth, you focus. When you're trying to protect what you have, you diversify. When you have nothing to protect, why would you diversify? Think about it like this. If you ever mess around with a magnifying glass as a kid, and if you just wave the magnifying glass around all over the place, nothing happens. But if you hold the magnifying glass steady, when you focus the sunlight on a single point, boom, you can start a fire. We didn't start the fire. It was always burning. Sorry. All right. So it's the same way with money. Focus creates heat. Focus creates power. power. Focus creates growth. Diversification spreads things out. It spreads out losses, but hey, it also spreads out the wins. So diversification can protect what you have, but you're also protecting yourself from winning. But if you're still building, you need fire, baby, not a safety net. This is the secret sauce. I just want to thank everyone who stayed tuned in this YouTube series. This was the last episode of this stock trading fundamental series. And if you completed this course, you know a lot about stocks now, from the market, from how the market works, day trading, swing trading, long-term investing, dividend stocks, growth stocks, ETFs, candlesticks, indicators, metrics, intangibles. I think we pretty much covered a lot to get you started comfortably in the stock market. And even if you haven't seen the whole thing, this YouTube series is just sitting here on YouTube for free. But this is not the end. If you want to play more fire with me, we're moving into a new YouTube series called From Stocks to Real Estate. Because true freedom isn't just about having a bunch of stocks sitting in a brokerage account. It's owning real assets. It's cash flow. It's leverage. It's generational wealth. So stick with me. It's about to get even better. Thank you, my friends. For more investing, finance, real estate, and macroeconomics, let's all learn wealthy together. I'll see you in the next video.